Okay, in the last episode, we talked about one of the things you definitely may want to consider doing if the government decides to relieve a certain amount of student debt. If you got student debt, if you know someone who has student debt, go back and watch that video, because basically what we said is if the government comes out, relieves $10,000 of that debt, takes it away from you, takes it off your back, what that really looks like once you add the interest onto it, and then what you should do in terms of going out and trying to find an asset to purchase, preferably one that appreciates and generates income. But if you find one that just appreciates, that has merit as well. But what you're looking for is a return of greater than 5.8%. Why greater than 5.8%? Because that is the average interest rate that folks with these loans, that's the average interest rate that they pay. So if you're going to pay the government or a loan servicer 5.8%, then you should be getting at least that, preferably more, 6% on at least on any asset that you go out and purchase as a result of now recouping this money, okay? If the government decides this is what they want to do. Now, we're going to talk about today another consideration that you may want to entertain with regard to this money. And at the end of this, you'll see how maybe what you may want to do is use a combination of both, potentially, depending on your situation. And again, we're throwing out concepts. You've got to do your due diligence in order to apply them if you think they have merit to your situation. So let's go. All right, let's do some level setting. Joe Biden, he said that he wants to relieve $10,000 worth of debt. Now, if he did that, that would basically eliminate the debt for 33%, roughly 33% of student loan borrowers, okay? Those who have taken out those loans, about 33% of them would be free and clear at that point. The Congress, the Democrats in Congress, they want $50,000 in debt relieved from the student loan borrowers. Now, look, we're not, just like in the last video, I'm not going to talk about the merits of this politically, or some people have moral consternation with it. Fine. But you know what? We are here on this channel, Money Changes Everything, to look at situations as they exist and then to figure out how we can advantage ourselves financially given the cards we've been dealt. So here we go. $10,000. Let's go with Joe Biden's lower, more conservative estimate. Conservative in this parlance basically just means the lower estimate, and not a political sense. We'll go with the $10,000. Usually student loans have a term of up to 20 years. So let's go ahead and do that. And then let's go ahead with that 5.8% rate that on average these borrowers are getting. So you see that just like in the last video, you're paying $70.49 per month. So this is what you should be paying yourself, okay? You should be putting that money back into your pocket. And we're going to do something a little different than what we did on yesterday when we talked about using the money to purchase an asset. You can apply what I'm about to say to that as well. And if you want to use this calculator, I'll include a link in the description. Go to bankrate.com and go to their calculators and get the student loan calculator. But look here, when you add in that interest, you're paying $10,000 plus almost $7,000 in interest over the life of the loan. Now, if we take a look at the amortization schedule, you can get a better feel for how that's going to work out. Again, I encourage you to go and pull up this calculator and run the numbers based on your situation, okay, or your child's situation. If you got student loan debt that you are partially responsible for, your child's debt if you co-sign for it. All right, so this is how it's going to look. And this amortization schedule can also help you to understand what you're putting into an asset or what you're putting into debt, because that's the other place, one of two places here. That's the other place you should be putting this money, either into an asset or into paying off debt. So one thing I want to do here is let's change the term. If you want to pay off debt, you might not necessarily want to take 20 years to do it. And when I talk about debt, I'm talking about the high interest debt or the inefficient debt, like a car payment, for example. Why do I call it inefficient? Because a car is depreciating all the time. All right. So that's debt that you want to, eliminate. It's usually a little higher interest rate, not as high as credit cards. Revolving credit cards are pretty high interest rate, even for folk with decent credit. You can get up there into the 10% range, even with them. So let's change this long term. Let's make it 10 years and see what this does. Okay, we made it 10 years. We'll keep everything else the same. Now we're paying monthly payments of $110.02. But look at what happens to the interest paid. It drops drastically. It drops in half roughly. Now, instead of paying almost $7,000 in interest, you're paying $3,200 in interest. But again, even if you decide to get disciplined and do this, and by this I mean use that student loan savings to pump it into debt, you still need to account for the interest because it's what you would have paid in the first place. So in accounting for the interest here, we're looking for debt that is in that 5%, 5.8% or higher. That's what you want to concentrate on paying off. If you have decided to use the money to eliminate other debts. Okay. Now let's talk about some methods that you can use to pay off the debt. Okay. The first method we're going to talk about here is the debt snowball. A lot of people are familiar with that method of debt elimination. Dave Ramsey talks about it a lot. And basically what you want to do there is you want to take the smallest debts, pay those off first, and then free up money in order to focus that money on the larger debts. Okay, that's one way. Then there's the debt avalanche. Now, Snowball, Avalanche, kind of, same motif there, but this is a slightly different method. This one pays off the highest interest rate debt first, and then the lower rates subsequently. Now, the thinking behind this is that if you pay off the highest interest rate debt first, then you're going to be saving a lot in interest, and you can direct that toward the other debts. I want to throw one in here. This is not the third one. In fact, this one, the one I'm about to mention, is the one that you should not ever consider doing. Splitting the payments between all of the debts equally. You really shouldn't do that, because while it can lower the amount of debt across the board, it's not really an efficient way to attack it. It just generalizes your debt instead of attacking it in such a way that's going to maximize what you're trying to do, either from the standpoint of the amount of debt, the interest rate, or as we see from an efficiency factor with the third method, which is the cash flow index. Now, the cash flow index, you calculate that by taking the total amount of debt and dividing it by the monthly minimum payment. So you look at each individual debt, you take the total of that debt, and then you divide that number by the minimum monthly payment. Now, the number you're going to get as a result of that is called your cash flow index. The lower cash flow index debts are considered to be inefficient, and you should pay those off first. Generally, the barometer is a CFI, or cash flow index score of 50 or below, would prioritize the debt as one that needed to be paid off sooner rather than later. Now, this method is using cash flow as the main factor in paying off the debt. The debt snowball prioritizes the amount of debt, the debt avalanche prioritizes the interest rate, and the cash flow index prioritizes cash flow. Okay, so let's give you a slight example because you may not have heard of this previously. If you've got that CFI score, that cash flow index score down below 50, and you pay off those debts, you're freeing up that cash flow. And then that is giving you some ability to maneuver with the other debts. Now, again, as you get closer to 100 and maybe beyond 100 on some of these cash flow index scores, these are debts that just should not be paid off soon or early, if you will. Take your mortgage, for example. We've talked about this before. Really, especially depending on your interest rate. And again, this is a concept. This may or may not apply to you, but as a general concept, your mortgage, that money is very inexpensive in terms of the interest rate. And from the standpoint of losing a tax deduction, the interest rate deduction on the mortgage, and putting yourself in a position where you could have used that money to get a return higher than, if you're going to make extra payments on that mortgage, you could have used that money to get a return somewhere else higher than the interest rate that you're paying out on your mortgage. So why would you lock that money up in your mortgage? You can't access it unless you go to a bank and get an equity line of credit or a loan or sell the house or get a reverse mortgage. All of those things depend on other people making a decision. It doesn't allow you to just tap into that home's equity. So that loan is very efficient, should not be paid off in most cases, should not be paid off early. So those are the three methods: the debt snowball, the debt avalanche, and the cash flow index. You can do additional study. I'll include some information to figure out what is best for you.